Hello guys, I'm Sai Teja. Today we'll discuss a very important topic of economy, that is Monetary Policy Committee. So let's start with the introduction. MPC is a body that decides the India's repo rate, which directly affects everything. This repo rate affects everything from our loan EMIs and inflation control. So in short, we can say that this MPC is the brain behind our India's monetary policy. This committee was set up under the RBI in 1934, which was amended in 2016 to bring this committee. Actually, this committee was brought to bring transparency and accountability in the system in the process of monetary policy formulation. Actually, what happened is before 2016, before 2016, these decisions were taken solely by RBI governor. So, but now to make it a collective data-driven decision, this MPC has been come up. Now it is a six-member body. Three are from RBI, three were appointed by the government of India. So as we seen, its origin is in 2016, and before 2016, a decision was solely taken by the RBI governor. Then that due to that, there had the concerns about the lack of transparency and accountability. So this was brought by RBI 1934, amended in 2016. So and also the major reason was uh, to bring this monetary policy committee was to adopt a flexible inflation targeting. So we have target of 4 plus or minus 2. 4 plus or minus 4 plus or minus 2 percentage. To maintain the main goal was to maintain the price stability while ensuring the economic growth. So our main target is to maintain price stability. Price should be stable. And there should be the economic growth also. So both should go parallelly. One should not affect the other. So this is our main goal. So composition, it consists of 6 members. 3 members are from RBI. Then first one is the RBI governor. He or she is the chairperson, ex officio chairperson. The deputy governor will be the in charge of the monetary policy, and one officer will be nominated by the RBI Central Board. The RBI Central Board will nominate a person to this committee, and the other 3 members will nominated by the central government, who are experts in economics, banking or finance, and accordingly who are experts in this, the central government will appoint them. The tenure of these persons, where government nominates or hold office for 3 years, so the tenure is for 4 years, and also it's more important, not eligible for reappointment. So this is most important from the prelims perspective, because this will be asked in prelims. They will say that they are the governor will ask question like they are again eligible for reappointment. So we should keep in mind that they are not eligible for the reappointment. So decision making, that is, each member has one vote and decisions are taken by majority. So decision is taken by majority. So if there is a tie, RBI governor has a casting vote. So RBI governor can has a casting vote when there is a tie. So the minimum criteria for it is to meet is they should meet at least 4 times in a year. 4 times in a year. So 4 times means, so they should meet at least for every 3 months. For every 3 months, they should meet at least once. This will fulfill the condition of this 4 times. But they usually meet bi-monthly for for once in a 2 month they will meet. The minutes of the meeting are and the individual votes members are made public for transparency. So the main thing, this is brought to bring the transparency and accountability. So to make this, the minutes of the meeting, the discussions of the meeting, and the voting of the members will be made public to bring the transparency. So the main objectives of India's monetary policy works under the, so first objective is it should work for the flexible inflation targeting, and also under is the it should maintain the price stability, that is to control the inflation, and also while supporting the economic growth and ensuring financial stability. So the price stability and economic growth should go parallelly. One should not override or overtake the other. So the sign for a perfect development of a perfect growth is that there should be both price stability and economic growth. So the government in consultation with RBI sets an inflation targeting. So currently, as I said, it is 4% with a tolerance band of plus or minus 2%. So the inflation can be between 4 to 6%. 4 to 6%. So if inflation exceeds 6% or falls below 2% for three consecutive quarters. Okay, so if for three consecutive quarters, if it falls below, if it crosses this limit of 2%, less than 2 or greater than 6, then RBI had to submit report to government explaining the reasons. It's okay. So it should explain the reasons and what steps can be taken to keep it in the track. So the key takeaways are from this are objective is the MPC objective is to achieve price stability, but without hurting economic growth. So balancing inflation and development. So we should balance both inflation and development. So now we will see what are the tools of monetary policy. We know MPC puts these things out, price stability and keeping the price stable. But how it does it? Now let us see. So for that purpose, it uses some tools. We can divide the tools into quantitative tools and qualitative tools. So quantitative tools, they are also called as general or broad based tools. So these quantitative tools control the overall supply of money and credit in the economy. Like how much money supply should be there in the market. That is the quantity. So this quantity tool decide that factor. So we can say they are the numerical in nature, hence called a quantitative. For example, the quantitative tools are the repo rate, reverse repo rate, cash reserve ratio, statutory liquidity ratio, open market operations. Now let us discuss one by one these tools. First, repo rate. First of all, its full form is repurchase agreement. Repurchase repurchase agreement. So the repo rate is the rate at which RBI lends money to commercial banks against the government securities. So by taking the government securities, RBI lends the money to commercial bank at at small tenures. And you can say the current repo rate is 5.50%. So now let us see what are the effects of this. What are the effects of this repo rate, like increase in repo and decrease in repo? So when there is increase in repo rate, borrowing becomes costly. So suppose if this 5.5% MPC changes this to 6.5%, then it will be then the banks has to pay more cost to the RBI to get the same amount of money. So the borrowings become costly. Thereby the banks either will the banks will take less loan, less quantity of loan from the less quantity of loan from RBI. Therefore, the money supply decreases. But even if the bank doesn't take less amount of money and maintain the same amount, but at, at final this interest rate will reflect on to the borrowers or the customers. So by any way the money supply in the market will decreases. So when there is a money supply decreases, the inflation will fall. So the RBI uses this tool when there is more inflation, and when there is more inflation and the RBI should, and to control the inflation, then the RBI will increase in the repo rate. Similarly, decrease in repo rate. So suppose if this 5.5% is reduced to 5%, then RBI will get the same funds at the lower cost. So it will borrow more funds from the RBI, and also it will give, and also the borrowing becomes the cheaper for both the banks, and finally transfers that cheaper rate to the customers or the borrowers. So the money supply increases. So when the money supply increases, there will be growth, because when there is more money supply, there will be more investment. When there will be more investment, when there is more investment, so when there is more investment, there will be the more jobs will be generated, job generation. Therefore, there will be the the growth will be stimulated. Reverse repo rate. So this is exact opposite of the repo rate. It is the rate at which banks borrow money. Sorry, it is the rate at which RBI borrows money from commercial banks. So, in the repo rate, we have seen that banks borrow money. Banks borrow money from RBI. Here, RBI is borrowing money. RBI is borrowing money from banks. So the current reverse repo rate is 3.35 percentage. Used to observe excess liquidity from the system. Similarly, when there is excess liquidity of money in the market, the RBI will increase this reverse repo rate. Suppose this 3.35 percentage increase it to 4 percentage, then the banks will park their funds at RBI. That is, they'll lend the money to the RBI. That is, and finally the amount of loan the banks gives to the customer or the general public will decrease. Thereby, it will decrease the money supply. It will decrease money supply in the market. So this is mainly used to observe the excess liquidity from the system. Next, cash reserve ratio. Cash reserve ratio. It is the percentage of a bank's total deposit that must be kept with the RBI in the cash form. That is, of the total deposits that the bank get. Out of that, some percentage of the deposits the bank must deposit with RBI in the cash form. So the current CRR rate is 4.2 percentage. So for example, if suppose a bank has got 100 crores, 100 crores of deposits. So if the CRR rate is 4.2 percent, that is out of this 100 crores, 4.25 crores 4.25 crores has to be kept with RBI, kept with RBI, kept with RBI in the cash form. So this is done usually to see that the banks don't advance or don't give more loans by overreaching that limit. So when there is higher CRR, cash reserve ratio, less money with the banks, same. If this 4.25 percentage increases to 5 percentage, then automatically the banks will have less money with the banks to give loans to the customer. Therefore, therefore there will be contractionary effect. That is, there will be less money in the market, and this is usually used to control the inflation. To control the inflation, just to decrease the inflation, lower CRR. So when there is a lower, when the CRR rate is lower, more funds will be available for lending. There is an expansionary effect. So if suppose this 4.2 percentage is decreased to decreased to 4 percentage, then automatically the banks will have more funds to give to the customers. Then therefore the money supply in the market will increase. So that we can say as it will have the expansionary effect. Next, statutory liquidity ratio. So it is the proportion of deposits that banks must maintain in the form of gold, cash, or government securities. So this ratio says that it is a deposit that the banks must maintain with themselves in the form of gold, cash, or government securities. That is, it should not deposit with RBI, but it should keep with RBI, but it should keep with the banks itself. So bank should maintain this itself without advancing, without giving loans out of this to the public. So in this, the qualifiable instruments are gold. It can keep itself with itself as a gold, cash, or the government securities, GSEC. So the current SLR rate is 18%. So this is also used to ensure the liquidity and the financial stability. So actually this is used to ensure the ensure both liquidity, both balance both liquidity and the financial stability. Because if there is no SLR provision, then what banks will do is they will advance more loans, give more loans by overreaching their limit. This may cause harm to the financial stability of the banking system, and the banks are the backbone for economy. So to maintain the financial stability, this SLR rate is much important. Open market operations. These are buying or selling of government securities by RBI in the open market. Like in the we know, like RBI will manage all the government finances, like selling or buying of its government securities. So in this open market operation, the RBI will buy or sell government securities. Like buying means, if it buys securities, then it has to give money to the borrower, that is any banks or commercial institutions or all India financial institutions. Then it will inject liquidity in the market. Injects liquidity in the market. There will be more money supply. Therefore it may lead to inflation, rise in inflation, increase in inflation. Okay. So and if in contractional, if the RBI sells, then the RBI will get the will absorb the money from the market. Thereby it leads to decrease in money supply in the market. Therefore we can keep the inflation in control. So yes, after discussing the quantitative tools, we will discuss now the qualitative tools. So comparing both quantitative and qualitative tools, the quantitative tools are much more important than these qualitative tools, because the quantitative tools control the total flow of money, but these qualitative tools will will give the direction. Will give the direction. It will give the direction of which that amount should go. So these are the non-quantitative methods used to influence specific sector, like which sector should get the more money, or which type of credit that particular sector should get. They are more about the direction. So as I said, it is about more of the direction and the moral persuasion than numbers. So it is only about the direction and the moral persuasion. So the tools used in this called quantitative method are margin requirements, credit rationing, moral suasion, direct action. So and I said, these qualitative tools are not much important. So just have a look of just have a look of what these tools are, and we will not go into depth. So we just see what is it. So margin requirements, it is the difference between the value of the loan and the value of the security offered. So suppose if we go to the bank and if we keep our security deposit security deposit of our gold of cost of its cost in the market is 1 lakh. So this margin requirement said that if a person comes to bank and keeps 1 lakh worth of gold, how much loan should that person get? Like now it is generally 75 to 80%. So if you keep that, if you keep the 1 lakh worth of gold in the bank, we'll usually get loan of 75 to 80,000. So this margin requirements will decide that. So if there is increase in margin, then the borrowing reduces borrowing capacity. So if this margin is increased, so this difference is increased here, the difference is almost 20%, but if this difference is increased to 30%, then that person will get loan only of 70,000. And when there is a decrease in margin, here the difference of 20%, if reduced to 10%, 10 to 10 percentage, then that particular person will get loan of 90,000, which is good for him. That is, it encourages the borrowing. Next, credit rationing. Credit rationing means RBI limits the amount of credit given to certain sectors. Like, it is used to control speculative or non-essential lending. Like, it ensures that all sectors should get the equal opportunity of gaining the loans, and it should not be the market speculation should not rule the direction of lending, should not rule the direction of lending. Like we have seen in 2000, in 2009, 2010, 10, what happened in US is, due to the more speculation, there has been more loans given to real estate real sector. Then there was a huge bubble created, and finally it led to the collapse of the economy, and it had impacted all over the world economy, and it has impacted the world economy. So this ensured that the loans are not based on speculation, but are given based on its worth. So morals question: RBI persuades a bank through a request or appeal to follow its monetary policy direction, and discouraging loans to speculative sector. Like so, it the RBI appeals to the banks to follow the monetary policy that is taken by the MPC Monetary Policy Committee. So direct action: RBI can take strict measure against a bank that fail to comply with its rules, such as penalties or restrictions. For example, we have seen S Bank, S Bank disaster. And finally, RBI has to step in to ensure the smooth steps to make the public deposits are safe. So yes, so in conclusion, we can say that quantitative tools control the total volume of credit in the economy, while the quantitative tools control the direction to which that credit should go. So together, these instruments help the Monetary Policy Committee achieve its main objective of, as I said, maintain price stability while supporting the economic growth. So there should be price stability plus economic growth to finally lead to the economic development. Economic development will lead to the development of India. So developed India by 2047. So now let us see some previous year's questions asked in UPSC CSE. Like one PYQ asked in 2017 about Monetary Policy Committee. So with reference to Monetary Policy Committee in India, consider the following statement. It decides the RBI's benchmark interest rate. It is a 12-member body, including the RBI governor and chairman of the finance commissions. So it functions under the chairmanship of the Union Finance Minister. So as we have discussed earlier, the first thought that comes to our mind is it is not a 12-member body; it is a 6-member body. So by elimination method, we'll eliminate this second option. Two are eliminated. Now we are left with only one and three. So that is that option A and option C. And also we have seen that it functions under the chairmanship of Union Finance Minister. But what I have said, the MPC will be headed by the RBI governor and not finance minister. So option 3 also will be eliminated. So we are left with only A. That is one only. So only one. So it is the it decides the RBI's benchmark interest rate. So now see a question asked in the mains. So in mains 2021 GS paper 3 economic development, a question has been asked. That is the Reserve Bank of India decision RBI's decision to focus inflation targeting has been applauded by many economists. However, it is also argued that excessive focus on inflation may hurt economic growth. That is, they are asking that matlab, the main conclusion of this question is that so the RBI should not exclusively or exclusively focus on the monetary policy that to control the inflation, but it should also keep the economic growth economic growth in mind. Economic growth in economic growth in mind, so as to attain the growth, economic growth and the price stability. So yes, yes, we can write the answer. We can write a 250 words answer for this question very easily. Yes. So thank you. So thank you very much.